Welcome to G Fun Facts Online. Have you ever wondered why the interest rate on a mortgage can feel like a roller coaster? One month it's down, the next it's up, and the rate your friend got 6 months ago seems like a fantasy today. It's an intricate dance of powerful forces, from the global economy all the way down to your personal credit score. Today, we're going to demystify this entire process. We'll break down exactly how mortgage rates are set so you can understand the journey from a headline about the economy to the specific loan offer you receive. Let's start with the biggest forces at play, the bedrock of the entire economy. At the highest level, the health of the national economy sets the stage for all borrowing costs. The single most significant factor here is inflation. Think of inflation as the rate at which your money loses purchasing power. For lenders, who are essentially investing in your home loan for 30 years, inflation is the arch nemesis. It erodes the value of the money they'll be paid back in the future. To protect themselves, lenders have to charge an interest rate that beats inflation. For instance, if a lender offers a mortgage at 4% interest, but inflation is running at 2%, their real return is only 2%. So, when inflation is high, or is even just expected to rise, lenders demand higher interest rates to compensate for that loss of future value. This is why even a small hint of rising inflation in an economic report can cause mortgage rates to tick upward almost immediately. Next up is economic growth. A strong, booming economy with low unemployment and rising wages is generally great news, but it can be a double-edged sword for mortgage rates. When people feel secure in their jobs and have more money, consumer confidence goes up. This leads to a greater demand for housing, and therefore a greater demand for mortgages. It's basic supply and demand. When more people want to borrow money, the price of that money, the interest rate, tends to rise. Lenders have a finite amount of capital to lend, and with more competition for it, rates get pushed higher. Conversely, during an economic slowdown or a recession, demand for housing and mortgages typically falls, leading to lower rates as lenders compete for fewer borrowers. The labor market, especially the monthly jobs report, is a key window into this economic health. A strong jobs report signals a healthy economy, which can lead to expectations of future growth and inflation, pushing rates up. A weak report can do the opposite, signaling an economic downturn and potentially lower rates. While these big economic trends set the general direction, the day-to-day fluctuations in mortgage rates are tied more directly to the financial markets, specifically the bond market. Now, here's a common misconception we need to clear up. The Federal Reserve does not directly set the interest rate on your 30-year fixed mortgage. Instead, long-term mortgage rates are most closely linked to the performance of the bond market, particularly the yield on 10-year Treasury bonds. The relationship is inverse. When bond prices go up, their yields go down. When yields on these Treasury bonds go down, mortgage rates tend to follow. But why? What's the connection? It boils down to a type of investment called a mortgage-backed security, or MBS. When you get a mortgage, your lender doesn't usually hold on to it for 30 years. They sell it. It gets purchased on a secondary market, often by government-sponsored enterprises like Fannie Mae or Freddie Mac. These organizations then bundle thousands of individual mortgages together into a single investment package, the mortgage-backed security. These MBS are then sold to investors like pension funds or investment banks in the bond market. Those investors are looking for safe, fixed-income investments, and an MBS fits the bill. This whole process is crucial because it creates liquidity. By selling your mortgage, the original lender gets their capital back immediately, which they can then use to issue a new loan to another homebuyer. It keeps the money flowing. The price investors are willing to pay for these MBS directly impacts the mortgage rates offered to you. If demand for MBS is high, investors pay a higher price for them. A higher price means a lower yield or a lower rate of return for the investor. Because the investment is less risky and in high demand, mortgage lenders can then afford to offer lower interest rates to new borrowers. If demand for MBS is low, their price falls, the yield goes up, and mortgage rates must rise to attract investors. So when you hear that MBS prices are falling, it's a strong sign that mortgage rates are heading up. And this is where Fannie Mae and Freddie Mac play their pivotal role. As the largest buyers of mortgages on this secondary market, they provide a steady stream of cash back to lenders. They then package these loans into MBS and sell them with a guarantee of timely payment, which makes the MBS much more attractive and less risky for investors. This guarantee helps keep the entire system stable and ultimately keeps mortgage rates lower than they would be otherwise. Now let's talk about the Federal Reserve, or the Fed. While the Fed doesn't set your mortgage rate directly, its policies have a powerful indirect influence. The Fed's main tool is the federal funds rate, which is the interest rate banks charge each other for overnight loans. When the Fed raises this short-term rate, it gets more expensive for banks to borrow money, and they pass those costs on to consumers through higher rates on things like credit cards and auto loans. This can have a ripple effect on long-term rates. A higher federal funds rate often leads to higher yields on Treasury bonds, which, as we've learned, are closely tied to mortgage rates. The Fed has another massive tool, buying and selling securities on the open market. When the Fed wants to stimulate the economy, it can engage in what's called quantitative easing, or QE. This involves buying huge quantities of Treasury bonds and mortgage-backed securities. This massive demand drives up the prices of these securities, which pushes their yields down, and as a result, mortgage rates fall. This was a key strategy used during the 2008 financial crisis and the COVID-19 pandemic to keep borrowing costs low. The opposite is quantitative tightening, or QT. To combat inflation, the Fed can sell these securities or just let them mature without reinvesting. This increases the supply of bonds on the market, which can lead to lower prices, higher yields, and ultimately, higher mortgage rates. So we've covered the economy and the financial markets. But that just determines the general, or par, rate for the day. The specific rate you are offered comes down to two more levels: the lender and you. First, the lender adds a margin, or a spread, to the benchmark rate. This margin covers their operating costs, salaries, office space, marketing, and their profit. The size of this margin is influenced by competition. In a market with many lenders, they may have to shrink their margins to win your business. It also depends on their risk appetite and even their current business volume. If a lender is swamped with applications, they might raise their rates slightly just to slow things down. Finally, we get to the most important part for you as a home buyer: your personal financial profile. This is what you can control. The rate you secure is a direct reflection of how risky a lender perceives you to be. The less risky you appear, the lower your interest rate. The number one factor is your credit score. A higher score, typically 740 or above, demonstrates a history of responsible borrowing and makes you eligible for the very best rates. Next is your down payment, which determines your loan-to-value, or LTV ratio. A larger down payment means a lower LTV. This gives you more equity in the home from day one and reduces the lender's risk if you were to default. A down payment of 20% or more will almost always get you a better rate than a down payment of 5%. Your debt-to-income ratio, or DTI, is also critical. This is the percentage of your gross monthly income that goes toward paying all your monthly debts, including the new mortgage. A lower DTI shows the lender you have more financial breathing room and are less likely to be overwhelmed by your payments. Other factors include the loan type and term. A 15-year fixed-rate mortgage will usually have a lower interest rate than a 30-year one because the lender's money is at risk for a shorter period. And the property itself matters. A loan for your primary residence is seen as less risky and gets a better rate than a loan for a vacation home or an investment property. Speaking of loan types, it's worth quickly mentioning the two main structures: fixed-rate and adjustable-rate mortgages, or ARMs. A fixed-rate mortgage has an interest rate that is locked in for the entire life of the loan, providing predictable monthly payments. An ARM, on the other hand, offers a lower initial interest rate for a set period, maybe 5 or 7 years. After that, the rate adjusts periodically based on market conditions. The lower initial payment is tempting, but it comes with the risk that your payments could increase significantly down the road. To put all of this in perspective, let's look at a little history. Freddie Mac started tracking 30-year fixed rates back in 1971. The all-time high was a jaw-dropping 18.63% in October of 1981, during a period of rampant inflation. In stark contrast, the record low was just 2.65% in January 2021, a result of massive economic stimulus. The historical average since 1971 is about 7.7%. This shows us that rates are cyclical. While rates today might seem high compared to a few years ago, they are still well below the long-term historical average. So to wrap it all up, the journey of a mortgage rate is complex. It starts with huge forces like inflation and economic growth, gets shaped daily by the drama of the bond market and the indirect hand of the Fed, and is finally customized by the lender and your personal financial situation. While you can't control the global economy, you absolutely can control the factors that matter most on your application. By building a strong credit score, saving for a healthy down payment, and keeping your debts low, you can position yourself to secure the best possible rate, no matter which way the economic winds are blowing.